Will PacWest Bank fail? The company's stock is down about 43% today, and the company released this news update saying that they were exploring strategic options, which involved selling assets that were originally classified as held to maturity or investments. And the company has said that they are going to, that they have been approached by several potential partners and investors, and that discussions are ongoing. That's not a great look. The company says they will continue to evaluate all options to maximize shareholder value. Basically, what that means is that PacWest is trying to sell itself. They are low on capital, low on equity. They are looking for a way out. Now, maximizing shareholder equity might be a bit of a euphemism because it's possible that shareholder value may be nothing. So really, anything above nothing is good for shareholders here. Now, how bad are things for PacWest, and why is this happening right now? Well, earlier this week, we had a First Republic Bank collapse. Now, it was taken into FDIC receivership, and shortly thereafter, it was sold to JP Morgan. JP Morgan pre-purchase, so before this week, JP Morgan already had more than 10% of all deposits in the US, which means by law, by anti-monopoly or antitrust law, JP Morgan shouldn't have been able to buy First Republic. However, they did because the government made an exception, because they didn't want the FDIC insurance fund to run out of money. That is not a surprise. Why not? Over a month ago, I wrote an article about how First Republic Bank was over $9 billion underwater as of the end of last year. Now, it got even worse this year in the first quarter before it eventually failed, but even at the end of 2022, it was insolvent. And that's not a liquidity problem, that's a solvency problem. That means it can't be solved by the Fed doing an emergency lending program. It also can't be solved by a bunch of big banks depositing $30 billion into First Republic. That can delay the insolvency, but it can't solve it. So here's how you can calculate if a bank is insolvent. You need to go to their balance sheet in their public financial statements. So annually, that's a 10K. Quarterly, that's a 10Q. 10K is the best because it's most detailed. Go to a 10K, the most recent 10K. Look at the balance sheet for that company. Write down some critical values. So total assets, the loans that are not measured at fair value, and the debt securities that are held to maturity. Then go to the notes of the financial statements. These are auditor notes and company notes that are detailed. Most people never read. But scroll down through the many, many pages of the 10K until you find the notes that describe fair value. Somewhere in there will be disclosures of the company's fair values. So a fair value is a market value. Banks by default report their loans at amortized cost, essentially however much they lend to you out, right? If I lent you out $100,000, then the bank will say, hey, I have an asset worth $100,000 because I lent it to you. But if you lent that out when it was a 2% interest rate and now interest rates are at 5%, then what would you rather have? A $100,000 loan that gave you, 2% return, or something that gave you 5% return? Well, obviously the 5% is much more valuable. So the market value of that $100,000 loan generating 2% is now much less than $100,000. So the difference between the market value and that original carrying value or principal value or balance sheet value can be quite large in times when interest rates change rapidly. And for the last year, interest rates have changed at a record rapid pace. So dig into the financial statements, dig into the notes to the balance sheet, find the fair value disclosures, and then adjust the balance sheet. So adjust the loans. You can see for First Republic, as of the end of 2022, the balance sheet said the loans were worth $166 billion. But the fair value of those loans was only under $144 billion. That's a big difference. The debt securities held to maturity were reported at $28 billion, but in actuality, they were only $23 billion. Big difference. So the liabilities, you also have to adjust those. You can see that the liabilities were stated at $195 billion. In reality, they were a little bit less than that. So the assets and the liabilities were both overstated, but the assets were overstated by a lot more than the liabilities were. So on First Republic's balance sheet from the end of 2022, they reported a shareholder equity of over $17 billion. But once you adjust their assets and liabilities for fair market value, what you would get if you liquidated the company, then you see that their actual shareholder value Their shareholder equity was negative $9 billion. That is insane. And it took months after that for the company to actually go into FDIC receivership, to be shut down by the government and then sold. So PacWest, as of the end of 2022, PacWest was not insolvent. It had lost a lot of equity. It had lost, I think, over half of its equity. The reported shareholder equity was something like 3.95 billion, and the actual shareholder equity just on the loan portfolio, there was I think around 1.7 1.8 billion dollars of unrealized losses. So they had lost roughly half of their equity once you adjusted for fair value. But it wasn't as bad as First Republic. And as far as we know, it's still not quite as bad as First Republic. So that's why we don't necessarily know, that's First Republic was underwater. PacWest was not necessarily underwater. Since then, they have taken a lot of extra funding. So they've taken on extra liabilities. They've lost some of their low-cost liabilities. So they've lost deposits. They've taken on high interest rate debt from the Fed. That will have shifted them downwards. So PacWest, it's uncertain. They may be insolvent. They may be nearly insolvent. Whatever their situation is, they are definitely weak, very weak, which means if they start getting deposit flight, people pulling money as fast as they can, they're going to have to start selling assets that are illiquid. And that means that they're not even going to be able to sell them. They're not going to be able to sell them at balance sheet value. And they're not going to be able to sell them at fair market value. They're going to have to sell them at less than fair market value, because that's what happens when you have illiquid assets and you need to sell them in a rush. So if that happens, that could very quickly squeeze the last bit of equity out of PacWest if it has any left. So if we look back at the first quarter 2023 earnings release from PacWest, we see that they have this statement of total insured deposits increased from 48% of total deposits at year end to 71%. How does that happen? How does PacWest go from 48% of deposits being insured to 71%? Because remember, any individual or business that has an account at First Republic and has more than $250,000 in that account, the excess money will not be insured. So there's a few ways that this percentage of insured deposits out of total deposits can go up. One, the company can lose big customers. If a wealthy customer leaves, then let's say a wealthy customer is anyone who has more than $500,000 in their bank account. If someone with more than $500,000 in their bank account leaves, then this percentage of insured deposits will go up because more than 50% of that person's deposits were uninsured. Second way that this percentage can go up, the company can engage in swapping. So let me explain this with a diagram. Suppose we have two banks, Bank 1, Bank 2. Bob, a random customer, deposits $500,000 into Bank 1. Alice, another random customer, deposits $500,000 into Bank 2. Now, each bank has 50% of their deposits insured and 50% of their deposits uninsured. Similarly, Bob and Alice each have 50% of their deposits insured and 50% uninsured. All parties, both banks, both customers, would like to have more of their deposits insured, because why not? So banks will engage in swaps. Bank 1 will still take $500,000 of deposit from Bob, and Bank 2 will still take the $500,000 deposit from Alice. However, behind the scenes now, Bank 1 and Bank 2, they will talk to each other and say, hey, Bank 1, I'll be Bank 1. Hey, Bank 2, I have this $500,000 deposit. Do you have another $500,000 deposit? Because if so, we could swap the excess above the $250K limit. Bank 2 says, you know what? I do. I have this customer, Alice. She has a $500,000 deposit. So now what do? Well, again, they both take their original deposits. So they both take the 500K deposit from Bob and Alice. But now Bank 1 will give half of Bob's deposit to Bank 2. And in return, Bank 2 will give half of Alice's deposit to Bank 1. So each bank has the same amount of money as before, but now 100% of all deposits are insured. And from Alice and Bob's perspective, nothing has changed. If Bob wants to withdraw $500,000, Bank 1 will just ask Bank 2 and say, hey, I need that $250K back. They will take it back, and Alice's deposit will also be given back. the way, this is how PacWest is increasing that percentage. They are engaging in these deposit swaps with other banks to try to increase the percentage of insured deposits at their bank, because they want to reassure customers that everything is okay and they do not want a bank run. So now, if Bank One is PacWest, then PacWest can say, hey, Bob, I know that you think you have to be worried because you have $500,000 here, but you don't actually have to be worried, Bob, because all $500,000 is covered by insurance. We kept $250 of it, and we put $250 of it in another bank on your behalf, so it's all good. That's why PacWest is trying so hard to do this, and why they've been able to increase their percentage of insured deposits. Is that enough? Uncertain. Let's look at back from Q1 2023, so for the first quarter of this year, what things have changed. So let's look at the non-interest bearing demand deposits. So these are checking accounts that don't bear any interest. They don't give you any interest to hold money in there. Typically, that's the majority of this. So at the end of last year, we had just over $11 billion, which was 33% of all deposits at PacWest, were these non-interest bearing deposits. And non-interest bearing deposits are very important because a non-interest bearing deposit is the best kind of deposit for a bank to hold, because they don't have to pay anything for it, right? It's essentially like you give them a 0 interest rate loan. You give them your money, they give you nothing. They just hold it for you and they reinvest it. So they don't actually hold it. But non-interest bearing demand deposits are basically the best source of funding that a bank can ask for. So you want that number as high as possible. So from the end of last year, it was 33% of all deposits. At the end of the first quarter, it was only 25%. So that means people are withdrawing their money from these non-interest generating checking accounts. That's bad for PacWest. That means in this dimension, at least, PacWest is worse off than it was at the end of the year. Now, in some other ways, it's better off. For instance, yields on some maturities have actually gone down slightly, because after the first banks failed in March, people thought that the Fed would have to cut short its interest rate hiking cycle, and that would imply that that bond yields would come down. So people anticipated that. So PacWest is actually slightly better off in terms of unrealized losses than they were at the end of last year. However, along the non-interest bearing deposit measure, they're doing worse. So some things better, some things worse. Now, let's keep looking. Also, from the first quarter, they said that net interest income had decreased by 43.7 million. So at the end of last year, for Q4 of 2022, they generated just about 323 million of net interest income. This time, this quarter, it was only 279 million. That's a pretty substantial drop. That's double-digit percentage drop in the net interest income. That's not good. As interest rates go up, a well-structured bank should make more money, not less. Now, there are several reasons for this. One reason is because PacWest took money from the Fed's emergency lending programs. That comes at a high interest rate, and it's a higher interest rate than you would have from customer accounts, right? From non-interest bearing demand deposit accounts, for example. And it's even higher than many of the loans that PacWest holds, which means they could be borrowing money at a high interest rate and lending it back out at a low interest rate, which is horrible. No bank wants to do that. Now, based on the fact that they still had positive net interest income, that's good. That means in net, they're still making money. But, it is a dicey situation, because they are playing with a relatively large loss here. So let's take a look at the net interest margin. We see at the end of last year, the net interest margin was 3.4%. That's the spread between what PacWest was paying out for its deposits and what it was generating in return from its loans and investments. At the end of this quarter, this first quarter 2023, that had dropped to 2.89%. So whereas a healthy bank, this number would be going up as interest rates go up, for an unhealthy bank, this number is going down. And there are multiple reasons for that. Again, taking out emergency loans from the Fed, drying up, people withdrawing their money from the non-interest bearing deposit checking accounts. And this week, after PacWest released their statement that they were exploring strategic alternatives, there were a lot of people on Twitter who were saying that they had withdrawn their money from PacWest just to be sure. So it's unclear. We don't have enough granular visibility as the general public to know how much money flowed out of PacWest this week. But you can bet your ass that billions of dollars flowed out this week from PacWest. So they lost a lot more. You know, they made a statement when they had their Q3 earnings call, which happened at the end of April. The first quarter of 2023 only goes through the end of March. And they said that, you know, so those numbers show that demand deposit and all deposits basically had gone down. And then they said, but in April, we actually regained 700 million of deposits. That's gone. There's no chance that that's still here. After PacWest has been scrutinized this week, at least that amount and more will have left PacWest, which is unfortunate for them.